Welcome to the award-winning Consumer Finance Monitor podcast, where we explore important new developments in the world of consumer financial services and what they mean for your business, your customers, and the industry. This is a weekly show brought to you by the Consumer Financial Services Group at the Ballard Spahr law firm. And I'm your host, Alan Kaplinsky, the former practice group leader for 25 years, and now Senior Counsel of the Consumer Financial Services Group at Ballard Spahr. And I'm very pleased to be moderating today's program. For those of you who want even more information, either about the topic that we're going to be talking about today or anything else in the world of consumer financial services, please don't forget about our blog, consumerfinancemonitor.com. We've hosted our blog since 2011 when the CFPB became operational. There's a lot of relevant industry content there. We also regularly host webinars on subjects of interest to those in the industry. So to subscribe to our blog or to get on the list for our webinars, please visit us at ballardspahr.com. And if you like our podcast, please let us know about it. You can leave us a review on Apple Podcasts, YouTube, Spotify, or wherever you access your podcasts. And also, please let us know if you have ideas for any other topic that we should consider covering on a future podcast show or speakers that we should consider as guests on our show. Welcome, everyone, to today's webinar entitled CFPB Final Rule 1071 on Small Business Lending, Key Changes from Prior Final Rule and Practical Implications. And I thank you very much for joining us today. We have previously conducted multiple webinars, podcasts, published numerous blogs about what I would describe best as a extended torturous rulemaking that has taken about 15 years from the time Dodd-Frank was enacted to where we are today. So we're going to be focusing on some very recent developments in small business finance regulation. The CFPB's revised final rule implementing Section 1071 of the Dodd-Frank Act. Yes, it's 15 years, and it took a lawsuit against the CFPB that forced them to begin a rulemaking to get us to this point. God only knows where we'd stand if that lawsuit didn't get brought. As many of you know, the CFPB originally issued a sweeping 1071 initial final rule in 2023. It generated extensive industry concern and the litigation, a separate piece of litigation. A lawsuit got filed shortly after that. To make a long story short, on May 1 of this year, the Bureau issued a substantially revised final rule that narrows the scope of the prior rule in several important respects, including by increasing institutional coverage thresholds, reducing the required data points, narrowing the definition of a, quote, small business, unquote, and narrowing the definition of a, quote, covered credit transaction, unquote, and extending the compliance date to January 1, 2028. Even with those changes, however, the revised rule will still have significant implications for banks, credit unions, FinTech companies, and other providers of small business credit, as it is defined in the final rule. Institutions are going to face significant operational, fair lending, compliance management, and other concerns. We published our blog about the final rule on our Consumer Finance Monitor blog. It's entitled, quite simply, CFPB publishes revised 1071 rule. If you go on our blog, consumerfinancemonitor.com, you'll see it was published on May 22nd. I'm going to now introduce our expert panel. And indeed, we do have an outstanding panel today, including two very special guests that they're going to help us analyze these developments from a lot of different perspectives. First of all, it's my pleasure to introduce Brad Blauer. Brad is the principal and founder of Inclusive Partners, LLC. He provides expert advice on fair lending, fair housing, and consumer protection issues, including responsible model development and the use of AI and data, development of compliance special purpose credit programs, and community development assessments. Brad's wide-ranging experience includes working as general counsel at both the National Community Reinvestment Coalition and Hope Loan Port, counsel at the civil rights law firm of Relman Colfax, head of fair lending at American Express, and a senior attorney at the Department of Justice and the Federal Trade Commission. Throughout his career, Brad has focused on expanding access to financial services to underserved communities. Second, it's my pleasure to introduce our second special guest, Louis Caditz-Peck. Louis is the Executive Director of the Responsible Business Lending Coalition, which is often called simply RBLC. It's an industry and nonprofit voice on small business financial protection and innovation. The RBLC and its members represent over 1,000 small business groups, for-profit lenders, CDFIs, and nonprofit community advocates. He's also a senior advisor to the National Community Reinvestment Coalition. Representing these different voices, the RBLC's board includes Small Business Majority Quantum Lending, Opportunity Finance Network, the National Community Reinvestment Coalition, and it's chaired by the Aspen Institute Business Ownership Initiative. These for-profits and nonprofits come together to stop the rise of predatory small business lending and improve small businesses' access to capital. Louis, earlier in his career, was at the FinTech Bank of Lending Club for 10 years, having joined in 2013 to launch Lending Club's small business lending program. Before that, he was a commercial lender in North Carolina at the CDFI Self-Help Credit Union. He also co-founded the American FinTech Council and the Marketplace Lending Association trade groups. He served as a senior advisor to the Aspen Institute's Business Ownership Initiative and the National Community Reinvestment Coalition, and at one time was on the CFPB's Consumer Advisory Board. And let me now introduce our colleagues, and I can assure you my introduction of my colleagues will be much shorter because I think all of you are very familiar with both Rich Andreano and John Culhane. Rich is one of the leading authorities on mortgage banking and consumer financial services regulation, regularly advises financial institutions on federal and state regulatory developments, including fair lending and CFPB matters. Rich concentrates in particular on mortgage lending, and over the years has become what I would say is a leading expert on HMDA, And of course, this 1070 rule is very much patterned on HMDA, even though we're talking about two completely different types of loans. Let me finally introduce John Culhane, who focuses his practice essentially on anything related to consumer finance in the regulatory sphere, supervisory sphere, enforcement matters, and regulatory counseling. So welcome to my two colleagues. Welcome to our two very special guests. And we have a lot to cover, so let's jump right in. And my first question is for one of our guests. And the question is going to really lay the foundation for the rest of this program today. So, Louis, to begin the conversation, why does this 1071 regulation exist? And what are the goals of it?
Thanks, Alan. Really happy to be here. And thanks, everybody. I can see in the attendee list, about 500 folks from banks and other kinds of lenders across the country. And so thank you, everyone, for being here. Nobody knows how much small business lending is happening and on what terms and to whom. The statutory purpose of Dodd-Frank in 2010 addressed that and named two statutory goals, which are number one, to facilitate the enforcement of fair lending laws, and number two, to enabling communities, government entities, and creditors to identify business and community development needs and opportunities for women-owned, minority-owned, and small businesses. And I just want to dwell for a moment on the value of helping creditors identify opportunities, because it speaks to why we've been some of the folks supporting it, like many on the call too, which is we can see that if this rule is enacted well, it'll lead to more and better small business lending, because the data, when it comes out, will reveal what products and practices are actually effective at reaching small businesses. And that will help all of us who are lending to build on those practices, to identify what we want to build, buy, partner, replicate, to develop programs that are more effective. And so in this way, we've looked at Dodd-Frank, looked at Section 1071 in particular, I should say. While there's been so much discussion of compliance cost, it's also really a kind of a light touch market-based approach for changing the dynamics of the market. It doesn't mandate any kind of lending. It doesn't create any kind of quotas. It doesn't require government subsidy particularly. It just tries to use the sunshine of transparency into what's happening in the market to help those markets work. Now, for that to happen, the regulation needs to provide sufficient transparency so that we can see how the market is working. And I think, as we'll talk about later in this webinar today, we think the current rule does fall short of that.
Okay. Rich or Brad, do you want to say anything more? Add anything to what Louis said?
I would just add that I think one point of the goals that was not really touched upon enough over the last 15 years of litigation and long winding road to this rule coming out is the benefit to businesses, not just to consumers, but the benefit to businesses to be able to understand the markets where they're doing business, identify opportunities, as Louis mentioned. And so I think too much of the focus was on the burden of collecting some data, publishing it, and perhaps exposing yourself to enforcement actions or private actions if there were patterns and practices of discrimination, which are already subject to under the Equal Credit Opportunity Act. So the point that Louis made about the goal being opening up markets to fairness, transparency, and competition was really an underlying goal of this, and businesses benefit from that too.
So I am going to go to our agenda, and we are in segment 1 right now, and we're going to be talking about first few questions that I have pertain to the CFPB's revised rule and policy direction. And my question this time is for you, Rich. At a high level, what are the most important differences between the CFPB's original 2023 Section 1070 rule and the revised final 2026 rule?
And thanks, Alan. Good day, everyone. I divide the main changes into four categories, and they're changes that reduce the lenders that are subject to the rule, changes that exclude certain transactions from the rule, changes that reduce what's considered a small business under the rule, and then finally, for the lenders that remain subject to the rule, changes that reduce the data collection and reporting requirements. So we'll touch on them quickly. As to the lenders subject to the rule, the original rule had no exclusion for any particular lender. The new rule has two changes. One, an exclusion for Farm Credit System lenders, but more importantly, the trigger. The original rule, making 100 covered transactions in each of the preceding 2 calendar years triggered application of the rule. The Bureau increased that significantly to 1,000 covered transactions in each of the preceding calendar years. Now, the Bureau's position is that really won't change things much because that the 100 transaction amount, they said that covered 94 to 95% of loans, and the change will reduce it to 92 to 93%. I suspect there would be people who would disagree with that assessment and believe that it will be a much greater reduction. Now, as to transactions excluded, the Bureau purposely did not exclude merchant cash advances from the original rule. They are now excluded, and they are defined as an agreement under which a small business receives a lump sum payment in exchange for the right to receive a percentage of the small business's future sales of income up to a ceiling amount. Also excluded. Oddly, for some reason, a lot of people believed agricultural loans were not subject to the original rule, and they were. They were very much. However, the Bureau received a lot of input on that and decided to exclude agricultural loans, broadly defined as a transaction to fund the production of crops, fruits, vegetables, and livestock, or to fund the purchase or refinance of capital assets, such as farmland, machinery, equipment, breeder livestock, and real estate improvements. Lastly, they added a small loan exception, and this is relatively minor. It's 1,000 or less, so relatively small transactions. That amount is subject to adjustment every 5 years, starting in January 1 of 2030 in $100 increments. Now, what is considered a small business? A significant change there. Not only did someone have to meet the definition of what is a small business under existing law, but they had to have gross annual revenues in their prior fiscal year of $5 million or less. The Bureau significantly reduced that to $1 million or less. So a big reduction in the revenue trigger, and that is subject to adjustment also 5 years after January 1, 2030 in increments of 100,000. Finally, the data collection and reporting requirements. Section 1071 listed a number of statutory data points and gave the Bureau authority to add points as it deemed appropriate, and it added quite a few in the rule that it adopted. Most of those discretionary data points have been removed, and the removed items include the LGBTQI+ owned status, woman and minority owned status, which is in the statute, that remains. The application method, such as in-person, online, etc., has been removed. The recipient, was it the lender itself or a third party, such as a broker? The denial reasons have been removed. The pricing information, which was the interest rate, origination charges, broker fees, initial annual fees, the cost for a merchant cash advance or other sales-based financing, as I said, merchant cash advances are now completely out, whether the transaction could have had a prepayment penalty and whether it in fact has a prepayment penalty, the number of non-owner workers, and importantly for the principal owners, they removed the disaggregated race and ethnicity. So similar to where there's disaggregated race and ethnicities choice at Hamda, the original rule had similar choices. Those removed. You only have the aggregate categories. 3 discretionary reporting categories still remain. The North American Industry Classification System Code for the business. Importantly, time in business. That probably should have been a statutory data point, frankly. It's very important when it comes to the success of a small business, is how long have they been in business. And finally, the number of principal owners, that was retained as well.
Okay. Well, Rich, thank you. So the next question is really for Brad first, and then I'd like to hear what Louis has to think about, say about it. Do you think that the revised rule still accomplishes the core objectives of Section 1071 of Dodd-Frank, or do you think the CFPB has narrowed the rule too much?
Yeah, I think the Bureau has narrowed the rule too much. When I spoke at a forum at the Bureau during Kathy Kraninger's term, we're going back like 8 or 9 years ago, I might have been happy if the Bureau had put something out that had included the congressionally mandated data points and a few other data points. But here we are, 15 years after Dodd-Frank was enacted, and the Bureau has put as its purpose with this rule to do a very incremental approach to this data. And so with the idea that we'll just start up very slowly and really limit ourselves to just the congressionally mandated data points and the three others that Richard mentioned. The problem is when you go back to the goal of the rule, it was to monitor for fair lending and to identify business opportunities in the small business space. And so that's very hard to do if you're not providing sufficient data for the government or for the public to really piece everything together. You're not providing the pricing data, the denial reasons, and you're cutting out a huge number of the percentage of the market. Whereas the Biden era rule that would have gone into effect covered, I think, 1,300 to 1,400 lending institutions. The new rule only covers around 170 financial institutions. And of that number, only 5 credit unions instead of the 120 credit unions that would have been covered under the previous rule. Those are the Bureau's numbers that I'm relying upon. So it's a much smaller number of institutions. You'll have geographies that are not included. And you'll also have some potential game playing that could go on to game the system. Businesses can look not just to the number of loans that they made in 26 and 27, the 2 years before the rule implementation is mandated in January of 2028, but you can go to 25 and 26 as your 2 years. So I think you'll see some institutions that are going back and picking whatever years will most benefit them so that they don't have to provide information. So short answer, no, I don't think it meets the objectives of the goals that Louis talked about at the beginning. It'll allow businesses to play games, and it cuts out a lot of the market. And so it's going to be much harder for the public to look at this black box of small business lending and understand what's going on. It'll be harder for nonprofit groups that are trying to monitor small business lending to figure out if there are patterns and practices of discrimination. So it's a start, but it's a weak start.
Yeah. Louis?
Yeah. Everyone on this call is involved in the small business lending market, and it's a really interesting one right now. It's a market that's changing really fast. There's a greater role of non-banks in the market. There's a greater role of smaller lenders in the market. Folks are trying different, newer companies are trying different kinds of lending techniques and technologies. Merchant cash advance is expanding incredibly rapidly to the point that the SBA has described this kind of product as extortionists. And the rule is narrowed to a point where it doesn't actually help us, the folks on this call, understand these changes in the market and understand how we would want to change the way we're running our business to be more effective in the market because of covering fewer lenders, fewer small businesses, fewer types of lending, fewer data points, to the point that, as Brad was describing, it's not really telling us what's happening. It's sort of a toe in the water to the point where I'm concerned that actually there'll be some unintended consequences to the extent that it's creating an unlevel playing field and skewing incentives that actually may be encouraging higher and rewarding higher priced lending at the expense of better loan products that many folks on this webinar are already offering. Just to illustrate that for a moment, I'm super concerned about the removal of the pricing data, because if the rule is only looking at our lenders doing a good job reaching underserved communities, but you're no longer talking about at what price, there is a perverse incentive that's created for market participants to try to boost their effectiveness at reaching smaller businesses and less well-served small businesses just by jacking up prices. And I think that's not going to serve those. It's certainly not going to serve those businesses well. It's sort of encouraging discrimination instead of discouraging it. And it's not going to serve those lenders well either in the medium term and long term as this rule changes and there's retrospective analysis, and that creates a kind of chaotic environment, I think, for everybody as well. And I think that ag lending is also something that I think we're disappointed is not in there, because if we care about farmers, we care about farmers' access to capital. That's important. That's a market that is worth improving as well.
Let me ask you a couple of questions. One is in terms of coverage. what about commercial installment credit? If somebody goes to an automobile dealer to buy a truck for his business and enters into an installment sales contract, is that covered? Is that considered a loan?
Yeah, auto dealers are out because they're out in the Bureau's jurisdiction. So they're not covered.
Let's take a different example, not auto dealers, but somebody buys some other equipment for their business and enters into an installment sales contract with the seller.
I think it can be. There are certain things that are excluded. The merchant credit, where you simply go in and you buy some inventory items and they let you pay 30 days later, that was excluded. But if it's a more formal financing arrangement, then I think that's going to be covered. Assuming they hit. Now, the thing is that with the 1,000 transaction trigger, a lot of those entities are not going to hit that trigger.
Yeah. Okay. Well, I thought it was covered under the proposal. I don't recall seeing anything saying that they weren't going to cover it. So I'm assuming it's covered.
People did request an exclusion and the Bureau didn't give it.
Right. Okay. Yeah. So merchant cash advances. Yeah, go ahead, Brad.
If I could mention one other thing in terms of the missed opportunity here, what's interesting to me too is the new rule allows for small business lenders to collect the demographic data at any point that's reasonable. Mm-hmm. And so the previous rule had required collection at time of application. So it's kind of ironic that the industry, which has fought this rule coming out for 15 years, and said the same industry that said we hate proxy methodology and using other data to kind of guess the race. Now, small business lenders can just wait to collect the data later and may end up using proxy methodology more because the rules are unclear about that. It allows a lot of latitude for when the lender can collect that data. So if the industry really wanted us to have more certainty and use actual data from the borrower, from the applicant about what their demographic status was, it's a missed opportunity.
Yeah. So let me go back to you, Louis, for a second. Merchant cash advances, why did that get excluded? I mean, if there was so much criticism of that product, why was that type of credit deregulated here?
It's hard for me to speculate on the motivations of the CFPB, but I would agree that it's a mistake and it's inconsistent with things that other parts of the administration are saying with respect to the risk that this product is posing to small businesses, using that term extortionists at the SBA, saying that this product is associated with small businesses having a very high fail rate. I'll also say that a lot of the bankers that I've been talking to are saying that they wish they knew more about how that market is working because it's making it harder for them to do their own small business lending. A banker I was talking to recently was saying that business development is harder for him because increasingly by the time they reach a business, that business has already taken merchant cash advances to the point where they're in that category that the SBA is describing. They're not a good credit risk anymore, and that is impacting banks' credit, portfolio performances, deposits. So I think it wasn't a great decision.
Yeah, I guess the answer is politics, right? That's usually it.
It's interesting that a lot of very small business lenders who do standard small business lending argued against an exclusion for merchant cash advances. So the industry actually was not fully behind that exclusion, and I suspect this rule will be revised at some date, and they're going to get pulled into this rule eventually.
Yeah. I think that's absolutely. It's going to be one of the early priorities if there is a change in administrations. So
I'll just mention, if that's the market you're interested in, there's a great new documentary out by More Perfect Union that was launched last week that we helped on, and it's already over 500,000 views, and it's 16 minutes and very entertaining. So you can Google merchant cash.
Where do you find out, Louis?
If you just Google More Perfect Union merchant cash advance, you'll find it, and it's sort of tragicomic.
Yeah. Okay. So John, we finally got to you. It took us about a half hour. Better late than never, though, I guess. My question for you, John, is what changes to the rule do you think are going to have the greatest practical impact on lenders?
Well, thanks, Alan. And as Brad indicated, I think the change that's going to have the greatest practical impact on lenders is the increase in the number of small business loans that have to be originated for an institution to be subject to the new 1071 rule. The CFPB went through some of the data that it relied on in 2023 and refreshed it a little bit and did an analysis of the number of depository institutions that would be covered as well as other institutions that would end up being covered. And as Brad said, the change with the number of depository institutions is dramatic. You have to take these estimates with a little bit of a grain of salt, but following the changes, the CFPB is estimating that the number of depository institutions that are going to be covered is, well, it said 170, but they've also said somewhere between 172 and 181. And they parse that as somewhere between 167 and 176 banks and savings associations and 5, unlucky credit unions that are still going to be covered by the rule. That's a dramatic reduction. If you look at the increase in transactions, and it's a 10% increase, that has cut the response, the covered institutions also by 10%. So we've gone from somewhere like 1,800 total depository institutions or more to maybe 180, 181 total depository institutions.
Yeah.
The NCRC has a good comparison chart. They've taken the information in the tables and cost estimates section of the rule and have that up on their website. I'd recommend that to anybody who's interested in seeing those changes displayed in that fashion.
Okay. Well, thanks, John. So the next question I have, maybe we've answered it to some extent, but I'm going to pose it anyway. And that is, how are consumer advocates, industry participants, trade associations, how have they been reacting to the revised approach? I know it was already mentioned that a lot of companies in the industry doing small business lending were not very happy with merchant cash advances being excluded. But I guess the other things, at least I've read, are that in general, the industry is happy with this. They were pretty much able to obtain what they wanted to. And, there's not, doesn't look right now like the industry is upset. Everything I've read is positive. But Louis, you probably have your ear to the ground, and probably you or Brad would have a better feel for it than those of us that are actually just industry lawyers.
I think it's been whittled down really far. Just to underscore that, you referenced earlier, Alan. I was one of the folks starting a small business lending program at a big FinTech lending club. And our borrowers had an annual revenue on average of $1.2 million. So our average borrower wouldn't have been covered. What does that average borrower look like? We're talking about small businesses that were borrowing $40,000 and had 3 employees. So if you're excluding someone who's trying to get $40,000 and has 3 employees, you're not really seeing much of the small business market. And so I think that folks that care about the small business lending market improving are going to seek to expand this at every opportunity. And so, unfortunately, what I think is there's just a missed opportunity here to achieve a kind of equilibrium. I think the choice to pare it down as far back as it is a choice to have regulatory instability on this. We had a situation where people have known, so many of our members, they said, we were ready to comply with the 2023 rule. We had built those systems. We could have done that. And now we're spending more money undoing work that we'd already done, knowing that we're going to have to spend more money again, redoing it at some point in the future. And, it's such a volatile world right now. But there's a missed opportunity here to try to achieve something that could have been more stable for folks. And this is more unstable.
Right.
And I would add that, I think, as I said before, the focus on the industry has been all about the burden. Like, we want to reduce our burden. Well, even though you don't need to provide pricing data and denial reasons as the lender under under this rule, you still need to collect denial reasons and data for your fair lending compliance and your adverse action notice requirements on these same loans. So you really haven't reduced any of your burden as a business, a small business owner. You've just created silos now that you have to connect, and you get none of the competitive intelligence that you would have gotten about the market. You get none of the benefits of the scheme that was supposed to make Congress asked for the Bureau to make the market more transparent and understandable. You get none of the benefits of that, and you still have all of the burdens because of your continuing obligations to meet the Equal Credit Opportunity Act, to meet your CRA obligations. So you have to collect all the same information, but it's in silos now, and you get none of the benefits of what the rule was intended to do.
Okay, let's move along to on the agenda. It's really segment 2, compliance and operational challenges. And my first question is for you, Rich, and that is, even with the narrower scope of the rule, what are the biggest operational and compliance challenges that institutions are still going to face?
Yeah, and I think here HMDA, again, is informative. And we saw that with the October 2015 HMDA rule, which, based on Dodd-Frank, added statutory data points and various discretionary data points. Now, that was adopted in October 2015. The Bureau provided for an implementation date of January 1, 2018. It knew the industry was going to need time to implement that rule. Remember, we already had HMDA reporting systems in place. We had policy, we had procedures, we had training, we had operations. But even with that, it was a heavy lift. Here we're starting from scratch, really. This is an entirely new regulatory scheme, and it's being applied to business units that aren't used to complying with consumer regulatory type requirements. So I remember the original, when I explained it to people, they didn't believe me that there's this rule that then was going to apply to them and they had to collect this data. They said, no, that's a consumer lending thing. I said, no, this is a small business lending requirement. So what I found with HMDA is you have to have buy-in from management, because they have to devote the resources, and mainly in 2 forms, technology and human resources. And technology will be big. Now, larger lenders were writing their own software systems to coordinate with their loan origination system. Smaller lenders probably may buy products that were written, and already there were various technology companies that were creating the software. They're now going to have to obviously revise that software based on the changes to the rule. But one of the key problems with HMDA data is the accuracy of the data, and that's, can you, in a efficient manner, move data electronically from your origination system to your reporting system. That's where a lot of errors occur in that mapping. What you want to avoid is the need for manual entry, because it's time consuming and error prone. So you want to do it electronically. And that's where I found, even in HMDA, a lot of lenders have problems with that, getting that right and having the data move over. So that, what I would say, focus on that significantly, train staff, have a team that's dedicated to this. The leader or leaders of the team need to have direct reports to senior management to say if they need more resources, and robust policies and procedures with your compliance management system, and robust training and testing. The rule allows you to test a year before it goes into effect. I would highly recommend testing to try to get it right. Even though there is a grace period in the initial year, I think that, you just can't throw a switch and expect everything to work. You really have to test it. So it's going to be a lot of resources devoted to getting this initially, and then ongoing, and then to implement changes, which I think are inevitable.
And Rich, if you were counseling a client about when they ought to begin doing all these things that you've enumerated, what's your answer to that?
If they haven't started, they're too late. I would, because I think you really want to be ready in early 2027. So you could start testing, start collecting, do it on a pilot basis, see if it works, see if your system can collect it. Can you move data from your loan origination system to your reporting system? I would take opportunity to voluntarily collect a year in advance. Now, you don't have to report that, but I would use that test period. So we're not far from 2027 right now when it comes to computer programming and training and all of that. So now the larger institutions, I think, we're closer because they had the early trigger date. The smaller institutions were kind of sitting on the sideline. now it is 1,000 transaction trigger, but that still covers, some entities that aren't the biggest banks in the world. So I think they need to be working on this now. And if they haven't developed their software, they need to start talking to some software vendors about their programs and seeing which one they may want to purchase.
Yeah. Okay. So, John, let me ask you, how should lenders think about implementation planning? Maybe you can just add to what Rich has already said. If you're just starting now, you're too late. But given the January 2028 compliance date, the possibility of other political changes, there might be litigation. We're going to talk about that in a little bit. But what would you add to what Rich had to say?
Well, to what Rich said, I would just add that I wouldn't be depending on litigation or political changes to have a significant impact here in terms of the startup of this compliance with the rule. We'll talk about where the cases are later. Political changes, the current CFPB isn't going to further change this rule dramatically, although it did say it might tweak some of the data collection points as it went along and saw how data was being reported. Trump's term runs through, doesn't end until January 2029. Maybe there's a change in administrations. The first reporting is in June of 2029. If it's still a Republican administration, I can't see there being any change in the rule. And if there's a Democratic administration, I think it's really unlikely that they're going to come in and blow up this system when it's so close to providing data, maybe not as broad of data as Brad and Louis would like, but providing data about what's going on in the marketplace. So I think hearkening back to what Brad said, you probably want to look at your 2025 originations because you can use, as Brad said, 2025 and 2026 to determine whether you're subject to the rule. And if you haven't got 1,000 or more than 1,000 loans in 2025, you can maybe breathe a sigh of relief and work on a longer timeline. Same thing for 2026. But if you're over, then as Rich said, you need to gear up and you need to start testing your systems and you need to do practicing during 2027 so that you're ready to go in 2028.
Right. I'm going to go back to you, Rich, and then back to you, John. And to some extent, this has been answered. But, Rich, what areas are likely to require the most attention and resources? Is it technology, data governance, employee training, fair lending monitoring, or something else altogether?
And I got to turn to HMDA, where I see most people having to devote the resources and where the failures are. And it's in technology and employee training. Just a lot of mistakes occurred because the employees don't fully understand the HMDA rule and reporting requirements. And that's something I think they're going to have to do here. There'll be just under HMDA, there's a filing instructions guide. And to me, that's the Bible of this reporting. And we'll get a revised guide for the new rule. But you need to have people that know that backwards and forwards. And your technology people need to understand it as well because they have to program their system to record data in the way that it must be mapped to be reported to the Bureau. So that's where I see a lot of failures are going to occur. And then I see what people also, as to monitoring, I tell people, do you look at your peer lenders' HMDA data? And some do, some don't. I say, well, don't you want to know what your competitors are doing? Forget the fair lending aspect, but it's important. From a competitive aspect, don't you want to know what your competitors are doing? Same here. I would be as soon as that is publicly released, the first thing I would do as a small business lender is give it to my analytics people and say, digest this. Tell me where are we doing it right? Where can we be better? What are our competitors doing? What markets are they penetrating that we're not? This is data you want to use just from a business standpoint. I know there's a fair lending aspect, but there's a business aspect to it. And I would really have analytics teams geared up and ready to digest this data.
Yeah. John, do you have anything to add to that?
Well, the only thing I would add to that, I agree that technology and employee training are going to be the big things for most institutions. But the CFPB called out a particular aspect of financial institution operations that I thought was interesting in terms of estimating costs. And they felt that the big expense for larger institutions was really going to be with internal audit procedures. So the time to start making sure those are working properly is now, as with basically all aspects of this rule.
Okay.
If I could just chime in on that one, Alan, I want to really underscore the points that Rich and John were making about looking at what the data says. Because I would say if we're just looking at this 1071 program as a compliance exercise, we're doing it wrong. Because it's not just, 1071 isn't just how do we report data. 1071 is how does the availability of that data change the market? And so in addition to the technology and the training that you're talking about, I think the smarter institutions will also be doing what Rich was describing, looking at the data and then making choices about product and marketing. Because the data is going to show how does your institution compare to other institutions? What opportunities are you missing? Where are you ahead that you can take advantage of more? It recalls to me that Warren Buffett has this great line, when the tide comes out, you see who's wearing their swimsuit. And the data is going to show what banks and lenders are actually doing a good job at reaching small businesses and which are not. And so don't just look at can you report the data, look at when we report the data, do we feel good about what it shows? Are we positioned to make use of how the availability of this data is going to intensify competition and shift and shift industry dynamics? And so I would encourage lenders to look at their product suite and say, do we have the products that are actually reaching these small businesses? There was a great publication that the Aspen Institute program that I work with, the Business Opportunities Initiative, put out called Scaling Lending to Entrepreneurs of Color, Strategies and Operational Tactics for High Volume Loan Originations. And they looked at what kinds of products are actually effective at reaching small and women-owned and minority-owned businesses. And they came up with a couple conclusions, which is one, folks obviously need small dollar amounts. They need unsecured products often because they may not have a lot of collateral available. And obviously they also need products that are affordable and transparent. Online applications can be advantageous and some things like that. And I think organizations that are just focused on, can I report my existing data and not looking at where the puck is going for what products they need and what marketing strategies they need are going to be behind the ball, to add a fifth metaphor there to that.
All right, we're going to have to move pretty rapidly now because we've got a little over 10 minutes left. We're up to segment 3. We're going to be talking about fair lending and supervisory risk. And my first question is for you, Brad. How important will this 1071 data be for future fair lending exams and enforcement activity?
I think it's going to be very important, and it kind of relates to what Louis was just talking about. We haven't mentioned yet that in the rule, the CFPB kind of naively says, hey, look, we don't care about discouragement. You don't have to compare yourself with your peers to see if you're not doing as well compared with those peers in the same market. But the Equal Credit Opportunity Act is still out there, and now data will be available about what your peers are doing. And if you're not monitoring for discouragement, you already have to collect the denial reasons and the pricing data for other ECOA and requirements. You're going to be caught without a bathing suit on. So you really do need to look at all that information. And even though the Bureau is telling you, look, the federal government right now doesn't care about discouragement, the courts do care about discouragement. The states and private litigants are going to have this information available, and they're going to be able to look at your peers who are in the same markets and see the number of loans that they're making and how many denials there are and what demographic groups the denials are coming versus acceptance rates. And if you're not monitoring that, even though the federal government's telling you in this rule you don't have to worry about it, you're going to be caught in a bad place.
Yeah. John, what fair lending and reputational risks should lenders be focused on now as they prepare for compliance?
Well, as we've been discussing, you have to think of this like HMDA, and in terms of reputational risk, you want to be looking at your raw data right now and looking to see what the disparities are, what the variations are in your lending in the small business space, because even that, if that can be explained, it's highly likely to give rise to reputational risk. And then, as Brad said, I mean, this is the time to look at your underwriting, look at your products, look at your marketing for signs that there's disparate treatment somehow baked into your system. And this is the time to fix that now.
Yeah. So, Louis, very briefly, do you expect state regulators and advocacy groups to become increasingly active in using Section 1071 data?
Absolutely, although they won't get it for a while. We won't have a rulemaking about how that data actually gets published for several years. So in the short run, I think they'll want to and not be able to. And then at some point they'll be able to, and they'll get it, and they'll be able to look at that data and apply it retrospectively. So there'll be a kind of a false feeling of security for a while that no one's going to see it, but eventually people will see it. And, circling back to merchant cash advance, I will mention that we worked with the state of California to pass a law that does a sort of a teeny mini 1071 data collection at the state level in California that covers merchant cash advance. So if you're a non-bank small business lender in California, you're probably already doing that reporting if you're doing non-loan products, and that can be a source of market intelligence too.
Mm-hmm. Okay, we're up to the final segment, litigation and looking ahead. Can't discuss any kind of a CFPB rule without talking about litigation because it usually ensues. But I want to go to you, Rich. And my question is, what's the current status of the litigation that was brought challenging the original 1071 rule? And how does this revised rule affect the case?
Yeah, we were tracking 4 cases. There are now 3 cases involving the rule, 3 challenging. One is the one in the Eastern District of Kentucky, the Monticello Banking Company case. And there, the district court granted the plaintiff's motion for preliminary injunction against the Bureau from enforcing and implementing the rule. That case has been stayed for a while, however, while all this other activity has been going on. And on May 22nd, the stay was extended to the end of June. And I think the parties are conferring in that case, as in other cases, to decide what to do.
If I could just jump in briefly,
sure.
The Kentucky Bankers Association and the banks in the suit have already said they're prepared to dismiss the suit without prejudice.
That's what I expect is going to happen. Yeah, and the other cases before one of the other cases before the Fifth Circuit, which stayed the rule when the Bureau dropped their opposition to the plaintiff's request for a stay. That stayed there. The lower court actually ruled in favor of the Bureau. They granted their summary judgment against the APA claims. There, we may have news quick. The status report is due June 3rd. I suspect we may see a resolution of that case as well. Third case challenging the rule was brought by the Revenue-Based Finance Coalition in the Southern District of Florida. A court similarly stayed the rule, and they have a status report due by June 30th. So in all of these cases, we're going to know relatively quickly, and I suspect we're going to see motions to dismiss without prejudice. One case, Rise Economy, which was one of the entities when it had a different name that brought the suit to force the Bureau to adopt the original rule, then brought suit to force the Bureau to implement the rule that it had adopted. And that was brought in the D.C. District Court. On May 15th, that was voluntarily dismissed without prejudice. So I suspect they could be at some point a plaintiff in future litigation. But I think we'll see a resolution to the 3 cases that were challenging the rule with voluntary dismissals.
Yeah, the Revenue-Based Finance Corporation basically got what they wanted with merchant cash advances being excluded.
Yeah.
What about the revised rule itself? So far, no new litigation has been filed as far as I can tell. And what's the expectation there? Brad or Louis, either one of you? You have a...
start. Yeah, I can start. I mean, I think even though this, is a missed opportunity because the Bureau poured out a pretty narrow and weak rule, I think the advocacy community is going to keep their powder dry for the most part because, look, it's taken almost 16 years for this rule to get out. Let's not put any roadblocks. Let's at least get this incremental approach started with a fewer data points and a narrower sector of the market considered. And let's get that started and not have a compliance or an APA challenge to it. But you better believe as soon as if there's a Democratic administration that comes into power, then they can make some changes to the number of data points that are collected and other things and try to make it a stronger rule. But my prediction is there will not be a serious challenge by the advocacy community to this rule because at least something is in place, and let's see how it works.
You agree with that, Louis? You're shaking your head, yes. Okay. All right. Looking ahead over the next several years, how transformative do you think this Section 1070 rule that will ultimately be for the small business lending market?
Okay, great. I think in the short term, to the extent that there's an unlevel playing field here, I think it'll disadvantage some of the banks and traditional lenders that are doing the compliance versus those that are the merchant cash advances and smaller institutions that are exempted. And as Brad described, if there's a change in policy winds, whether it's a change in party or whether it's just a change in political philosophy towards trying to help small businesses, then that hopefully will come around to advantaging lenders that have developed smart, interesting small business lending programs that are doing a good job. And it ultimately, however long it takes, this is going to become a rule that is intensifying competition in small business lending and accelerating the changes that are already happening in the market, where there's more and more different kinds of small business lending products that are being developed and different technologies and the banks and lenders that are right now figuring out what will help them win in the market are going to come out best on the rule, and most importantly, come out best in the market, market share.
And my hope is that the business community will, in the next couple of years, realize, hey, this could be a better rule if we actually do have to provide some more data that we're already collecting, because we want to find out what our competitors are doing. So that's my hope.
Right. Hope springs eternal, right? Rich, I'm going to give you the final question, and because you are certainly our leading expert on HMDA, and as we addressed earlier, HMDA was expanded significantly from its original structure in 1975. Do you think envision a similar path for the 1071 rule?
Yes, and the original HMDA statute and rule looked much different. The original rule really didn't even have demographic information collected. It was designed to determine where banks were lending for compliance with the Community Reinvestment Act. That was the original design. They didn't add demographic data until 14 years after the original adoption. And it's been greatly expanded since then, both who is a HMDA reporter, the loans that are covered, and the data points. I see it inevitable that unless Congress does something to 1071, assuming 1071 stays as it is inevitable that they'll remove some of the exceptions like merchant cash advances, agricultural lending. They'll assess the 1,000 covered transaction trigger. They'll add pricing information and probably other data points. So I see it's inevitable. Exactly when, that I can't say, but it's inevitable that it will be expanded similar to HMDA.
Thank you, Rich. And we are at 1:00. That's pretty good timing. I want to thank all our panelists who were just terrific today. First of all, our two special guests, Louis Caditz-Peck and Brad Blauer, and my colleagues in Ballard Spahr in the Consumer Financial Services Group, John Culhane and Rich Andreano. And most of all, I want to thank all of our listeners who joined us today. We very much appreciate your participation, and we look forward again to seeing you either on another Ballard Spahr webinar. We don't have anything right on the agenda right now, but we are in the planning stages of several additional webinars. But one thing you can be sure of, and that's every Thursday, you will see a podcast show from us on our Consumer Finance Monitor podcast. So with that, I hope everybody enjoys the remainder of their day. Thank you again.